well, good to have everyone on. So this is our first official macro insight call. Let's keep it as interactive as we love to do. I'll take you through my thinking on markets. I'll take you through some of my charts that I'm looking at and some of the trades I've been doing. And, you know, feel free to quiz me on that and let me know what you're thinking and what you're doing. Okay. Probably the obvious chart to kick off with is Nasdaq. So you know, we had mentioned obviously my scenario for the Nasdaq after that initial sharp sell-off had been that we were kind of carving out a B wave bounce, and I was expecting some sort of C wave sell-off. And you know, I had been trading that range, picking it up at around the 11.1, 11.2 area, and then letting it go at around 11.5 with a view if it got to 11.8 where there's some confluence, I was going to short it to play that C wave down. Now, obviously, we ended up getting the C wave. Well, assuming this is the C wave that is happening now, we had that over yesterday and over the weekend. You know, pretty much just breaking down those levels of support that had been carving out around 10,900. Now, I did a quick check for where the confluences were below that. I found levels around 10,550, and again, some levels around that sort of 10,100 area, right? So that's the levels where I've been placing my bids now, to think that if this is a C wave that's kind of in progress, I would expect it to kind of reach a terminal point somewhere around those levels, right? So, you know, right here, right now, for choice, after that bounce off those lows yesterday, I think market's probably an okay short here with a tight stop to play those lower levels, right? So I'm of the view that Nasdaq is still targeting around that 10,550 area as a minimum for this correction to be over, and then for some larger degree rally to resume. Yeah. So it's all getting a bit concerning on the COVID front. If we look at European markets, you know, European markets did take the brunt of it yesterday, having held up pretty well in the face of the tech correction the last few weeks. Finally, the DAX took a bit of a beat down. So let's bring up the DAX. So it had been doing pretty well, hanging around that sort of 13.2 area. And then we had a brutal sort of 3.5%, 4% sell-off, right, pretty quickly. So Europe kind of joining the party. Generally, you know, I haven't been playing European Delta myself that much, you know, given that it was just kind of coiling and not really having much direction. I haven't been doing a lot with it. I think the Euro Stoxx is at a bit of a cliff edge right now. If you have a look at the Euro Stoxx chart, worrying these levels, I would say. So if we do see a break lower in Euro Stoxx from these levels, yeah, that could definitely open up the way for, you know, another 200 points, which is what, 6% slide, which could start looking quite ugly, right? So if we look at some of the growth numbers, some of the economic numbers, you know, we've been talking about the economic data stalling, right? And this, what we're seeing on the COVID front is clearly not going to be good for growth at the margin, right? So the idea, the prospect of more harsh lockdowns, as we're seeing in the UK, people are worrying, you know, whether we're going to have to go into lockdown within the next month. People talking about potential case counts of in the tens of thousands by middle of October. And, you know, Spain's not looking great on that front either. So at the margin, you would have thought this COVID stuff is probably not good for growth. And whilst European markets have kind of run out of steam, right, we weren't rallying with the tech stocks on that crazy mania that was happening with the tech stocks. So, you know, there are headwinds here, clearly. Now, the Fed obviously signaled at their meeting that, you know, they're happy to let inflation run hot, and, you know, going towards targeting more average inflation. So we've seen that, right? The market kind of front ran the inflation story, and you saw commodities have a massive rally over the last few months. Now, they seem to have put in a bit of a local top, commodities. We'll see if that's, you know, that plays out, how that plays out. But you know, you look at some of the swings in commodities. I mean, lumber was exploding and it had a massive correction. Nat gas, same thing, exploding, big correction, right? So you still got a few commodities holding up, like some of the agricultural commodities and copper. You know, they're still doing pretty well and they look like they're still ascending. But some of the big movers in commodity space have now had pretty sharp corrections, yeah? So the question now becomes, you know, are we in a sort of slow growth, high inflation environment going forward in Q4? Or are we in a slow growth and actual slowing inflation, so more deflationary impulse? And that tends to be a much worse environment for risk assets, right? And that's where you might see the dollar remaining relatively well bid and commodities and equities under pressure, basically, right? So I think watching commodities and seeing how commodity price action evolves over the coming month is going to be quite important to give you a feel of where we are basically in terms of, and again, to use Hedge Eye's kind of a lens, you know, which quad are we in, right? Are we in quad 3, where you've got inflation and weak growth, so more of a stagflation environment, or are we in quad 4, which is a more of a deflation environment, basically, right? But clearly both of those scenarios are pretty weak growth environment, right? So growth is not accelerating, right? Growth is decelerating. And so it's going to be, you know, a bit of a wall to climb for risk assets probably in Q4. It looks like that's how we're setting up. Okay. One of you know, the main drivers for risk assets rallying, I would say over the next couple of months, if we're going to get any rally, we're going to be looking for, what have we been relying on? We've been relying on vaccine headlines and we've been relying on fiscal stimulus out of the US. Okay. And the problem with that is vaccine headlines, as you've seen, are becoming less and less impactful on the market, right? So anytime there's any sort of vaccine related news, it's not having as much impact on the market and getting much of a rally out of the market, because people are starting to understand that even if you have a vaccine, it's going to take a long time to administer. The fact that it's been released so quickly means less and less people are up for taking it. You know, it's not the silver bullet necessarily that people at first thought it was. And then you've also got the stimulus in the US, which, you know, we're still waiting for. The Democrats and Republicans are pretty far apart. And the fact that we're only about a month and a half away from the election is making it potentially unlikely that we're going to get an agreement, right? So we're either not going to get an agreement until after elections, and then obviously there will be some sort of stimulus passed, you would think, or Trump is potentially, you know, waiting or you know, kind of gaming it such that they can get a deal done just before the election, and they get a load of stimulus checks to the people in the US, and they're all signed by Trump, and everyone's like, yeah, what a great president, let's keep him back in for another 4 years, right? So I don't know if that's what's happening, if it's basically gaming that, but the odds are, you know, you're probably not getting a stimulus in the next 2 weeks. So for the rest of September, unlikely to get any positive news on the stimulus front. You know, vaccine isn't really helping at the moment. So I would say this sort of correction in terms of timings, I would think it continues sort of playing out over the next couple of weeks. And then if we're going to get a bounce into the election, you know, it might be because you're getting an agreement between the Dems and Republicans and Trump puts something through and people get their checks, or you get Q3 earnings as the other catalyst, right? So we're going to start to have Q3 earnings in October before the election. And, you know, what often happens with earnings is you get people bringing down the guidance and the bar getting lowered for earnings, and they come and slightly beat earnings and the market has a bit of a relief rally, right? So if the market stays weak for the next 2 weeks, then there is an impetus for a couple of things that could provide that catalyst into the elections, right? So that's kind of how I see things playing out potentially. So I wouldn't be in a rush to buy this market right now. Okay. Now, another thing to be aware of is the US election risk, right? So, you know, I got you guys to look at the VIX term structure, and we bring it up here. So what the VIX term structure was doing when you had a September contract at around 25, we had this big hump in the October contract. And the reason was because the election date was early November. So that forward vol contract for October contained that date, and it was implying something like a 5-6% move on election day. Now, what's happened to the VIX curve is the hump has now pushed itself out to November, which basically means that there is more volatility premium being priced in the mid-November to mid-December bucket of time, right? Which is basically saying that the probability of a contested election in the US is much, much higher. And the vol market is pricing quite a high probability that in early November, we will not know the election result. So you'll get someone claiming to be a winner on the day, and then over the following weeks, as the postal votes are being counted and stuff like that, the uncertainty will linger on, right? So it's going to be a contested election most likely. Now, what can happen with a contested election? I mean, there was a contested election back in 2000 in the US, and the S&P sold off 13% on the back of that, okay? But that was a big surprise. Whereas now we're not going to be surprised if there's a contested election. So maybe it's not so dramatic, the move, but the point is the uncertainty is going to linger, okay, right? If that also happens, there is a risk of civil unrest in the US, right? Because the Dems will be saying we've won and the Republicans will be saying we've won, and there could be all sorts of civil unrest in the US. Not a great time to be long markets if that's what's going to happen, right? So the problem is you're going to get this bid in implied volatility persisting until the election and maybe after the election, okay? And that's not generally an environment where markets just like rally and take out the highs, basically, okay? So I think that's something to be very aware of and something to keep an eye on. And actually, if we start to see civil unrest kick off in the US, then you could potentially see quite a bit of dollar weakness, I think, on the back of that. Now in FX space, I mean, probably the most interesting one I'd say is the pound at the moment. Obviously we had the slide on the back of Brexit risk kind of increasing. We had a reasonable bounce, right? Up to here. And I feel now after hearing Boris speak and kind of ratcheting up the restrictions on Brexit, the natural obvious thing to happen next is an extension to the furlough scheme, basically, okay? If he's going to put a load more restriction on all our lives and all our businesses, then they're going to have to roll the furlough scheme, right? Which is running out in October, okay? So if they roll that furlough scheme, that just means more printing, right? More printing in the UK probably means a weaker pound, yeah? And you've also got Brexit talks carrying on. You've had the Bank of England talking about, you know, negative rates and what that means. So there's quite a lot of stories out there that can be negative pound. So if we break, I mean, this 127.5 level seems to be quite a key level. If we break that 127.5 level in pound, then your next stop is like 125. Yeah. So that's kind of what I'll be looking at on the pound. Yeah. I mean, you know me, I like structurally being short pound. I'm getting quite excited about selling pound, especially if it breaks 127.5. If it breaks 127.5, I mean, I've got some puts expiring on 15th of October, struck at 127.5. Those are the ones that I rolled. I had some short dated puts and I rolled them out a bit to like keep the premium alive. So I feel quite good about those puts. But, you know, I've even pressed the short a little bit today. I sold some more around 128. I'll probably sell some more at 129.8.5. With a relatively tight stop, probably above, you know, recent highs. Let me get the hour chart. So those recent highs there at 128.60. So I think pressing a short on pound is not a bad trade here, given the setup, and with a stop, let's say above 129. Don't get yourself into too much trouble. 100 pips, but I think the downside could be quite big in the pound right now. Yeah. Especially if the dollar kind of carries on rallying, right? Which it seems to, you know, the dollar seems to be in the process of a bounce right now, the DXY. Yeah. So anyway, so we talked about the pound. We talked about general broad dollar having a bit of a bounce. Obviously, you know, dollar weakness has been persisting for the last few months. Finally, the dollar's had a bit of a bounce here. You know, that's come along with a bit of risk off sentiment. Now, I got a bit lucky on this dollar ZAR trade. You know, I've got a mean reversion monitor that I use, which is a combination of Bollinger Bands and momentum divergence. And so last Thursday I flagged I'd been monitoring some of these emerging market currencies because, you know, I felt they were looking stretched, and I thought they might be a nice way to enter into a long dollar trade. And that's pretty much exactly what I did. So, you know, if you look here, let me expand this thing. So we had, you know, on the daily chart, we had, you know, we were at the lower Bollinger Band on dollar ZAR around sort of 1630, and we were having some momentum divergence in terms of the composite indicator that I like to look at. So and I thought that's not a bad expression of going long dollar. So I paid I paid 1630, and then we went on to get a quick 4% rally up to 1690 yesterday. I actually took profit on that at 1690, and I've literally just rebought it again at 1660 because I think this might have some more legs in it, this dollar move. And you know, if you look at that daily chart, that could be a complete correction, right? That correction there down to this low here, that could well be a complete correction. And if we're going to get a dollar charge, there could be a hell of a lot more upside in dollar ZAR, basically, right? So I quite like owning dollar ZAR here. Obviously, if we took out that 1610 level again, that would disprove the theory that the correction's over. But I've already taken some money out of the market and I've re-entered it here, right? So I quite like that position. So I'm planning to keep that unless it makes new lows. Yeah.
What makes you say that dollar is strengthening? Or what's your rationale behind being long dollar for now?
Just because I expect there's a bit of I think there's a bit of a shift from, you know, the quad 3 stagflation scenario where dollar's getting battered and commodities are rallying, because we're starting to see quite a few commodities rolling over now. Yeah. And we're starting to see a stalling of growth, and we're unlikely to see stimulus getting passed in the next few weeks. I think that's a setup for the dollar strength to continue, basically. Right?
Is that in the short run until?
Short run, totally short run. Longer term, I think dollar's toast, most likely. Yeah, because the only thing they can do to bail out the system is to print more, right? So I think the 2 trillion plus will get passed in the US. I just think it's not getting passed in the next couple of weeks, right?
Okay.
So I think at the margin, this DXY chart, you look at this DXY chart, it was having a load of momentum divergence, bullish divergence. It's now bounced and it's threatening to take out this level here around 94. So there is definitely a chance that DXY can take out 94 and go back to 96, right? If it gets back to 96, I'm getting the hell out of Dodge, right? As in, I don't see why I want to hold on to it back up there, right? That would be quite an impressive bounce from the sell-off that it's had. So that's kind of what I'm playing right now.
Okay.
It's just a tactical dollar long, because I think generally risk assets are in a bit of a precarious spot, yeah? And I think it's going to take at least a couple of weeks for them to work through that, yeah?
Okay.
Okay, so that's my kind of FX expression at the moment. Now gold, let's bring up the gold chart. Yeah, so gold's an interesting one, right? So you know I've had gold in the pension book for a long time. It's been a great trade. Managed to kind of put in a hedge in place on that after that blow-off rally. And then I was holding those puts that expired, when did they expire? A week or two ago. And they were expiring a week or two ago, I think. So I rolled them into some end of November puts. So I'm now holding the 1850 puts basically against my pension long, okay? And when this triangle that was forming here in this consolidation, when that broke yesterday, I basically doubled my size on my puts, right? So I, because I was a bit light on those puts anyway, right? Those puts don't fully hedge my entire notional of my pension long, because I want to be long gold, whatever. I'm just using these puts as a bit of a tactical hedge because I think there's a correction in gold that's playing out. And that break of that triangle was the catalyst for me to buy some more of those puts. So I own those 1850 puts to November. And yeah, I think the correction, I think if this triangle break is real, then I think the correction towards, 1830, 1850 is the one that I'm playing for. At which point I would probably monetize my puts and stay naked long gold again. Yeah. but I'm quite happy to have some puts in place at the moment. And you know, on the call side, I haven't got any calls. If we were to break back above 2,000 on the upside, I might consider selling some calls as an overwrite against my long gold position. But right now, I'm happy to just sit on the puts because I don't think the puts are very expensive in terms of implied vol. I think they're around at 18 vol. So they're cheap enough to carry at the moment. And, you know, like I did with the puts last time around when the market sold off, if the market sells off with some volatility, then I will utilize those puts by maybe buying some delta at 18.30 and jobbing around that delta if that sell-off comes over the next couple of weeks, for example. Yeah, that's the game plan. Make sense? Silver, similar sort of story, right? But obviously silver's more volatile. So if we look at silver, you know, it looks like a pretty clean correction so far. You know, you got those lows, you bounced in there. So, you know, you could definitely make a case for silver being a complete ABC correction, and we're going to go off to the races again on silver. But like I say, because I don't think gold's done yet, I think silver's probably got some more legs to come off. Yeah. If we do some quick retracements and see where we are on silver. Right, so you can see, right, you can see the levels in silver, right? So you've got a bit of a band between 23 and 23 and a quarter here. You got another one at 21.90 to 22.20. So you got a couple of bands here, and then you got another one at 20 and a half there. But that's pretty dramatic because that's going to be taking out quite a lot of that rally. So if that impulsive rally was a third wave of some kind, and we're now in a fourth wave correction, then, you know, I would expect that fourth wave correction to complete itself either around that 23 and a quarter level or around that 22 level, basically, right? And if that coincides with an 1830, 1850 level on gold, then you're getting excited about getting back into silver there, basically, right? Yeah. And if you look at the momentum, right? I mean, there's no momentum divergence in sight, right? I mean, silver's getting battered with negative momentum right now. So what I want to see is I want to see silver down at 23 and a quarter with momentum divergence, maybe even 22 with momentum divergence, and then I'm getting excited about getting back into that trend. Yeah, because the fundamentals, obviously, if you think the same fundamentals for silver apply to gold, there's fundamentals of gold apply to silver, then you know, you don't mind the fundamental story, but it's about when to get into it, basically, right? Now, I've always kind of been a bit wary about the silver story because I think it's got a big industrial element in terms of being used in things like smartphones, solar panels, stuff like that. But given the re-rating that silver had from you know, when it broke 17 and went straight to $30, I mean, I'm very much an advocate of listening to price action, and that price action is telling me that this thing could have some explosive returns to come over the coming years. So if I get an opportunity to get into that again at 22, 23 area with the right signals, then I'll be doing that. Yeah. Good old Bitcoin. I mean, they've been pretty choppy. I mean, to be honest, I think they've held up reasonably well in the face of the tech sell-off. Yeah. These cryptos. So, you know, they got down to kind of what level, 9,900-ish level, then bounced pretty hard to 11, and now they're selling off again. Yeah, they're volatile, right? But, you know, they've got these story, they've obviously got the same sort of monetary debasement story going on, but then they've also got this whole adoption. If you get mass adoption of cryptos, then they've got way more to run, right? But that story doesn't happen overnight. That story takes months, years to play out as more institutional people enter that market, right? So if you believe that story, then, you know, you've got to own some Bitcoin and Ether long term and just accumulate them as and when, you know, buy dips in them and accumulate them up to an amount that you're comfortable holding for the long term. And that's how I'm approaching them, basically, right? So I'm still happy to hold. I'm not panicking on it, and, you know, I will continue to accumulate on dips in the crypto space for now. But I would only hold those two. So I would generally hold Bitcoin, whatever my crypto exposure I'm comfortable, right? And remember, this you need to, your crypto exposure needs to be, you are willing to take a 50% drawdown in your crypto exposure in a week, right? So if you, whatever size of crypto you buy, if you're not comfortable with that being down 50% in a week, then you're too big, basically, right? So that's how I size my crypto exposure, okay? So, and that's good because then crypto becomes a bit of an option, right? Crypto becomes like a call option that doesn't decay, right? Because you're like, I'm going to put an amount of money that I can write off, and I know it can go to zero, or it can certainly halve in value quite quickly, yeah? But it can also go up 10x over the next 5 years, yeah? And that's the way to think about crypto. If you think about crypto like that, it's much less scary, basically. And it actually becomes exciting, and it becomes an opportunity, right? If you think of crypto like a regular, normal asset class, then it's just it's the Wild West, and you don't know what the hell's going on, right? So that's not the right way to approach crypto.